From a conflict that never seemed to want to go away to inflation now elevated over 4% and a labor market that seems stable these last 30 days really had interest rate elevated. So now that we have the conflict behind us, allegedly it's going to be 8 on Friday. What does all of it mean for the housing market as well as interest rates? So thank you so much for tuning in. Greatly appreciate it. So let's just dive in. Last month, we got promise after promise after promise from this current administration that this conflict was going to be behind us. We'd see interest rates drop down a little bit. We'd see the activity pick up a little bit. Only days after, it would be an absolute reversal. We would see missiles flying. It would create more uncertainty. And look, it's like the three little pigs. How many times can you cry wolf? And the big thing that really happens with this conflict, we've been in it now for months and months and months, is energy prices continue to escalate. And when energy prices escalate, that means inflation escalate. And that's exactly what we saw this past month in the read on inflation from a data standpoint. We got CPI came in at 4.2% year over year. And you have to remember that inflation is compounding. It's unsustainable from a standpoint of an economy. As we can see, we just got data the other day. The economy shrank in April due to this conflict. So the conflict pushing oil over $90 a barrel, sometimes up to 110 plus over a period of 5 to 6 months now, it's just not good for the overall economy. And that's why we're seeing elevated inflation. And that has been the major concern this past month. And that has led to elevated interest rates. I mean, you took a 10-year treasury all the way up to about 4.7%. Now, thankfully, bank spreads have been really kind to us this year, because if we look at past bank spreads and you look at the years of 2024 and 2025, we would have been sitting at 7.5%, maybe 8%. So thankfully for the bank spreads and the government purchasing of mortgage-backed securities, we are able to keep interest rates lower. The other surprise we got was the sustainability and the growth of the labor sector. We've been told that AI is going to take everything over. Oh, high inflation is going to cause a bunch of layoffs. And it was the exact opposite. So obviously, with all those things, we can completely understand why interest rates were elevated throughout these past 30 days. And what it did is it created a lot of people to be on the sidelines, right? Affordability is the biggest concern. You got insurance premiums going up and you had elevated interest rates. And therefore, we had somewhat of a slow go in the real estate sector. And for one of the first times in history in a long time, we had more sellers than buyers. Now, real estate is very local, so it all depends on where you're located, but that was the overall theme. So these last 30 days, was it a lot of false promises? In my opinion, it was, but if you were strategic about it, you had great opportunities out there. So now let's look ahead really quick. And oh, by the way, my name is Kevin Weedmark, AKA the Mortgage Mouth. Each and every month, I come to you with a mid-month update, just bring you up to speed of what happened in the last 30 days. Let's talk about what's going to happen in the upcoming 30 days, make some predictions so that you can be strategic and you can be informing your clients. Or if you are a consumer out there yourselves, you can make sure that you are putting a strategy together that's going to create wealth for you, put you in the best position possible, offer you the best interest rate out there, and give you the lowest costs out there. All right, so let's look ahead. Now, the conflict, right? It looks like it's behind us. Apparently, we're going to get a wet signature, as we like to refer to it in the industry here, on Friday. And it looks like we have somewhat of a 60-day pause where we're going to see if we can pan all this out. We're going to open the strait. Things are going to flow back to normal and everything's going to be wonderful. Unfortunately for us, interest rates are not going to plummet. I'm here to tell you that. Everyone thinks that interest rates are all of a sudden going to fall back to normal. That is not going to be the case. It is going to be a slow and steady process. And the reason is because inflation now is going to be the most talked about topic for this upcoming month as it pertains to the real estate market. Because last month, as I said, we got CPI came in at 4.2% year over year. You had PPI from a services side come in over 1%. Everything is on the rise. A lot of traders are assuming, hey, it's really relevant to energy prices being elevated, but it's going to take time for that to come back through. Even though oil may slip down to about 75, $70 a barrel, prior to going into this conflict, we were running at about $65 a barrel. But it's going to take time for all of that to flow through the system. It isn't like this price today jumped because we had elevated energy prices from $2 to $2.50. As we all know, as Americans, vendors, companies are not willing to just lower that price. So it isn't like, oh, oil went all the way back down. We're just going to reduce our price now back to $2 instead of $2.50. That's not going to be the case. We are going to have to learn to live in these elevated pricing structures, and it's going to put a little bit of rub on the economy. So, what do I think it means for interest rate? I think we're going to see that 10-year recover from around 4.55 to 4.6. We're going to see it settle, in my opinion, somewhere probably around 4.35 to 4.4 over the next 30 days. We are not going to see that drastic drop until we start getting data that indicate inflation is coming back down. It's getting closer to the target rate, or at least in several months of data, we're seeing that inflation is on the downslope. We're not going to see interest rates drop drastically. And I'll just pull this up really quick. Here's the 10-year Treasury. As we can see over the last 5 days, we've gone from about 4.57 to 4.45. This is with the conflict being, you know, behind us. As we can see, it's not going to be a drastic drop. Now all eyes have turned to inflation. So although the conflict is still going to be one of the big market movers for the next month, in my opinion, inflation's going to be number one. And as we can see, it moves right lockstep with oil. Oil for the first time, I think is below $80 a barrel. I think that's great. But do I think it's going to all of a sudden cause those interest rates to drop suddenly? I don't. As we say all the time, interest rates take the escalator up and they take the stairs down, unfortunately. So we're going to have to deal with that. The other thing I think that's really going to be big this month is the Fed. We do have a Fed funds meeting this week, and it's going to be their vernacular. They really have changed from a dovish standpoint, where we were really hoping to get a Fed funds rate cut this year, to a very hawkish approach where they're very concerned about inflation. They got a healthy labor market, so they don't have to be concerned about that, but they cannot have elevated prices, which means therefore they cannot be lowering interest rates. And as a matter of fact, they may need to increase them. If I pull up this chart, by the end of December, you're looking a 60% chance that interest rate will be on the rise from the Fed funds rate standpoint. And I'm not saying that's going to be a bad thing. I don't think that's going to be really bad for interest rates, because remember, the Fed funds rate affects short-term rates, not long-term rates. So I think that's going to be a little bit healthier for the market. I think it's going to allow us to get a little bit more stabilization, rein in inflation a little bit. And I think that will bring more people back into the 10-year Treasury market. And therefore, we will have the lowest interest rate since the beginning of this year. We will once again see them, if not a little bit lower, Q2 to late Q1 of next year. So that's the wrap right now. Once again, I thank you so much for tuning in. Make sure you hit that subscription button. Every day I bring you an episode of the Daily Dose, so you never miss a beat. But let me know your thoughts. I'd love to hear your rate predictions for the next 30 days. I'm saying they're going to come down about an eighth to a quarter point. So as always, be strategic. Make sure you turn to your mortgage lender. If you don't have a great one, you need one. You want somebody that's authentic. It's this guy right here that's willing to talk to you about yield spread premium, using that to offset those closing costs, knowing that better rates are coming in the future. Because our goal on this channel is to always keep you informed, first and foremost, but to save you money in both costs and rates. So make sure, if needed, you give me a shout out. Happy to talk through any scenario with you. Once again, thanks for tuning in. Cheers.